Okay, Richard, it is May the 5th, so it's right after May 4th. So for all the nerds out there and for you, May the 4th.
What is mate? Oh
Yes,
God.
May the 4th be with you. Yeah. So, hey, we're sitting
Now
here.
listen, I've just got to have to say that Star Wars died for me um, with the Ewoks.
It died for me with Jar Jar Binks.
Yeah. Okay.
That was
Yeah.
the final straw. Yeah. But it's an interesting time because it's our evening. Friday is done, and we've just had this pretty big move. Well, in the markets, crypto's up quite a bit. Like I think Bitcoin was up, 2-3%. Ethereum was 5-6% up, a little bit higher at its high, and the markets overall were up too. Apple had really good earnings. They're up, 4 or 5% now. So it's an interesting day, and over the course of the last couple of weeks, we've seen some interesting things in the markets. We've seen these regional bank failures, and hey, crypto took a move. It was like this flight to safety. People were saying, and okay, maybe, but it's it's not consistent. Sometimes the market goes up and crypto's goes up. It shouldn't be going down. Sometimes the market goes down and crypto goes up, and vice versa. It doesn't seem like it's exactly makes sense all the time sometimes. So it's kind of an interesting situation we're in. As
Yeah. I mean, look, you know me. I think people try to read too much into the tea leaves here. I mean, 3 days ago, the story was the global banking system is collapsing, therefore Bitcoin up. The next day, it was global banking system collapsing, therefore the risk off, Bitcoin down. And then the next day, we've got an FOMC meeting, interest rates go up to 5.25%. Homeowners are going to start bleeding out of their asses, and yeah, crypto up. And oh, by the way, and a bank failure as well today. Another one.
yeah,
So,
yeah, yeah. And then throw in that there was that fake, it was a Mount Gox news or something that happened a week or so back. Yeah, it's just been very volatile, very sporadic, and I think even guys that are just focusing on the equity markets have really been struggling. Not just the last week or two, but the last couple of months. It's been a tough go. So it's interesting. I mean, we typically sell vol. That's our shtick for the most part when we do other things too. But you have been focusing a little bit more on the programmatic trading in the
yeah.
last few months. And actually, this week you built yourself an auto hedger, right? So let's just talk a little bit about the strategy there, just the basics. We don't have to go into give away all the secrets or
Yeah.
anything, but let's just kind of talk about the general principle of that.
Yeah, so I mean, as well as being one of the road traders, I do options trading as a job to earn money to make rich people even richer. And um, one of the bits of voodoo that we do is we actually run hundreds of thousands of tiny strategies across in what we call back tests. So we actually take the historical data of the markets and run a strategy across that data as if we were trading it on an exchange. And we do that in parallel using GPUs, and we run tens of thousands of them at once. And we see which ones generate value consistently, and then we try and understand why. We group them and compare them and do an analysis on them, and then we take these strategies and piece them together to say, okay, well, if we took a bit of that one and a bit of that one and a bit of that one, then it would make money here, lose money here, but that one would offset by the other one, and we'd overall make money. Um, and we try to understand where the markets are mispricing options and futures actually as well. And when I say mispricing, I don't mean, look, Bitcoin has the right price of 30K and they're trading it at 40, therefore sell it. It's more a case of because of the technical mechanics of the way that options work and the way that forward curves work and futures work, we're looking for systemic mispricing. We don't really care about the price of the underlying. That's kind of the job of the auto hedger. So what we're looking to do in a nutshell is buy vol that's too cheap and sell vol that's too expensive, but without getting too exposed to Vega risks and all the rest of it. And actually, then we let the auto hedger just hedge the delta, and it just sits there and buying and selling futures to keep our delta more or less flat all day long. that auto hedger just sits there and burns money all day. It's like always buying high and selling low, it's always buying high and selling low all the time, right? It's just burning money all day long, but it doesn't burn as much money as we're making on the mispricing of the options. That's kind of the long story of my day job.
Yeah. And you're saying the auto hedger is out there every 2 minutes, not necessarily trading, but looking if there's a certain percentage discrepancy, and then it will execute. So it's basically every 2 minutes, it's checking.
Yeah, I mean, and you can get super hung up on the technicalities of these things. Our auto hedge is super simple. It just sits there and monitors the market every 2 minutes and says, are we out of limits? Okay, buy. Simple as that. And that's because we're working in crypto where the mispricings are huge. So we don't really care too much about giving a few pennies to the market as yet. I'm sure as the markets become more sophisticated, then we'll have to start getting more competitive. But for right now, we've got other stuff to worry about. And that actually changes the way you trade. So whereas if you're a typical vol seller, you're selling iron condors and managing the side that's wrong and so on. When you've got an auto hedger, all you do is look around for value and just buy or sell it, don't care, and you just let the auto hedger do all the stuff. So stuff like buying protection, stuff like checking every 4 hours to see whether the grind up is carrying on or not. You just don't care. You sleep soundly. So at the moment, I'm in a situation where, so just to get a bit technical, the watchers may or may not have heard about the volatility surface. So we have this idea that not all options trade at the same volatility, because in situations like now, if a market starts to move, then it's probably going to continue to move, particularly in crypto. And so the more out of the money options tend to have a higher volatility. And that means if you were to draw a graph of volatility versus how close you are to the money, that graph would trace like a smile on someone's face. And so what I've done just now is sold some options that are higher up that smile. And as the market moves up, those options, we're getting closer to the money. So those options are moving down the smile. So actually they're dropping in vol as they're getting deeper in the money. And that means that they are essentially giving up that volatility value, even though they're getting more expensive. That doesn't matter. That's offset by the fact I'm buying futures. And so those options get cheaper. And in fact, even when they get in the money, start getting deeper in the money and going up the vol smile on the put side, well, there's then the skew. And right now, the market has got it in its mind that crypto's going up. And so prices are skewed towards calls and not towards puts. So that position gets even cheaper because it's now being priced as a put. Because if you remember your lessons from watching Shane, an in the money put is actually the same as a out of the money call plus a future, right? So you price your in the money calls based on the puts.
There's a couple of interesting things in there that I think that even for someone who's not technical and who wants to look at this, you just think about. Most people think, hey, I'm going to sell this option for $1.50 or $500, or if it depends if you're trading stocks or crypto or whatever, and then I'm going to buy it at a lower price. There's nothing wrong with that. We want to sell high, buy low, or buy low, sell high. But what you're talking about here is we don't care about the price. We're looking at the volatility. So we're selling the volatility. Even though the price is going up, the volatility is dropping, and that's okay because we've got that auto hedger in there, and eventually we're going to make money because we're going to buy that back at a lower volatility, or it will expire. So it's just a different way of thinking about it. And we can break this down and be simple about it. We can just say, look, let's just say we're selling vertical spreads. We're selling call spreads. And the market makes a big move up and we see some resistance. We're happy to sell some calls and we'll buy some calls at a higher price. Don't think of it necessarily in the price. If the volatility was at 45% and it's gone up to 56%, great. We're selling that 56 vol. The price may end up, not moving much in the upside or going up or a little bit, but as long as that vol, that IV starts coming down, that's what we're really, really looking for. And I think we've talked about this before where, pro traders don't even care about the price. They're just talking about vol. I'm selling a 67 vol, I'm buying at 40 vol or whatever. And at the end of the day, we want to buy volume when we think it's going up, and we want to sell volume. We think it's going down. It doesn't always exactly work that way, but that's the idea. The other thing I want to mention, and you said something at the beginning where, we're looking at, increasing prices now. I just want to make this clear. If you and I were just to sit here and we're going to buy the S&P 500, we're going to buy Apple, we're going to buy Bitcoin, we're going to buy whatever right now, and we buy the underlying asset. Well, you know what? It's a dice roll. What's going to happen tomorrow? It's 50-50 chance. It's going to go up. It's going to go down. I don't know. You don't know. Sometimes we have some ideas, or some things that might be happening, or some news, or maybe the technical analysis, or whatever. But really, it's a 50-50 shot. We think that the markets are mostly random, not completely random. But as you said, as things start moving up or as things start moving down, it tends to keep moving in that direction. And you can talk about, like in physics, an object in motion tends to stay in motion. But there's actually a very, very good reason for this. Let's say, things start puking and just falling down. What's going to happen? Well, more people are going to jump on the bandwagon. More people are going to have to cover their position, which puts more pressure on it and keeps it going. That's why it's not truly random, I think, in our opinion. I think, would that be accurate? Yeah.
Yeah, and it's actually exacerbated by people like me. So I'm currently running a book which is small. It's just a test book of $500,000, right? But that book is soon going to be $200 million. And when that book starts to auto hedge its way through a rally, it's going to do some serious buying, and it's going to be starting to push the Bitcoin price up itself, and that means it's going to, as I go through my strikes and my auto hedger starts buying more and more futures to match the delta, it's going to start forcing the futures market above the spot market. So the spot buyers are going to start buying because of the arbitrage, and sooner or later they're going to buy so much spot that it pushes us through the next strike, and then somebody else has to go and start auto hedging their book, and through it goes until all the shorts are taken out or all the longs are taken out if it's going down. Yeah, for sure. So there is this kind of there's the basic premise in options pricing is that markets have, in order for there to be a formula to price an option, i.e. the Black-Scholes equation, options markets have to be continuous and have to be what we call stochastic or random. And the reality is that they are neither continuous nor stochastic, but we fudge the figures to allow us to use the Black-Scholes equation because it's all we've got. And so actually the way we price options is we use the wrong model with the wrong inputs to get the right price. So we basically fudge the figures until it feels right, is the reality.
Yeah, and I think I'll mention too, for someone who's new or doesn't have access to software, like we have, things like that. Well, the Black-Scholes, like you said, it's fine for theoretical, but IV, look at IV, because markets are pretty efficient and traders are building. IV is basically fear built in. Fear, optimism, all those emotions are built in. So if you're not sure where to go, IV is going to be a pretty damn accurate way to look at things. The other thing I'll mention too is you say, okay, you've got this fund, it's $200 million. It starts auto hedging, starts pushing the price. A lot of people think, well, you know what? Hey, $200 million, that's not so much in these markets that are trillions. But look at
it. Yeah, but in crypto, it's quite a lot of money.
It is a lot of money. I was just going to say, look at almost any given weekend. We'll see some goofy little move up or down, when everybody's closed, everybody's away, low volume. And it's, it'll move at 0.5% or 1% or something like that. And every time it happens over the weekend, you're like, it's going to come right back down. And almost sure enough, it does, or it goes right back up, because there's just not a lot of people there. So yes, you got a $200 million fund. You got all these other funds who have their, they're basically, their machines are plugged into it. When you start triggering a run, they're going to have to auto hedge, and it starts that avalanche, moving it up or down. And why doesn't this happen in traditional markets? Well, it does. But they're more mature, they're more developed, they're tighter spreads. It's just a little bit more mature, and there's a whole bunch of other reasons. They're bigger too. They're trillions. They're thinking about the FX market. I mean, it's massive. Trillions and trillions of dollars.
Yeah.
So.
The FX market probably is super deep, and very few actors can move that. But I know equity markets can be moved. I remember when somebody fat-fingered Volkswagen on expiry day. And,
Yes.
I mean, I was short a bunch of calls that were close to the money, and my broker couldn't get hold of me actually, and he went and bought 50 calls on FTSE to protect me. And thank God he did. I would have lost about 200 grand, but I ended up making 50 because he acted on my behalf. Because somebody, I don't know, bought 100 million shares when they should have bought a million. It was ridiculous, and that moved the whole FTSE index. So yeah, oh, and you know why? Because they actually bought more. They had there had been more options sold on the VW stock than there were shares in the market, and so all those people who had to try and race to cover couldn't cover.
To cover, yeah. Yeah, I do remember, and I think that we've seen, and hey, let's face it, there's a lot of thinner traded stocks out there too, which can be pushed around. If you want to put it on the S&P, that's a little different story, obviously. But there's all kinds of interesting opportunities there.
Yeah, so I'm just looking for opportunities now actually, because we've had this big rally. You know what?
Well, are you talking about the crypto rally, or are you talking about the equity markets? Because I think he's up about.
I've not traded equities for a long time now. I'm just looking for opportunities. I'm seeing this big rally. I'm thinking this has to be causing vols to rise in Bitcoin, and indeed it has, because what normally happens on a Friday night is that the vols get crushed down over the weekend, because the general mantra is that no one trades on the weekend, right? Even in Bitcoin, which is supposed to be a 24-hour market, but in the end everyone has to sleep. And the majority of the volume in the options market in crypto comes from Europe and the US. So in Asia now, particularly, no one's trading. So a hot tip: if you ever want to move the crypto markets and cause the options guys to have to cover, do it in Asian hours, because the options markets get super thin.
Right.
So what normally happens on a Friday night is that the implied volatility of anything under 1 week drops to about 40%. Right now it's trading at about 50,
52, 53.
50%.
Well, I was looking at the D-vol on Deribit. It's probably around 52 or 53%, I think.
Yeah.
For
Bitcoin. So at the moment, implied vols are trending towards being equal to the realized daily vol. But that's actually not stopping me selling it. I'm just selling a bit further out. So I'm selling like in the 10-15 delta range, which you normally shouldn't do if you're in retail, because you haven't got an auto hedger, and you definitely shouldn't be selling these teenies. But for me, it's fine. I just sell it and let the machine take its course.
And just so people know too, typically in traditional markets, normally, when prices go up, volatility drops, because everybody's happy and most people in the world are long and things are good. It's when prices drop is usually when volatility spikes.
Yeah, and actually so 2 years ago, when we had the big bull rally, vols were going up as prices were going up, because everyone was assuming that crypto was crashing upwards. It was the dollar's doomed, let's all buy crypto business. And then when crypto dumped after FTX and Terra Luna and all the rest of it, and actually just started dumping because it was all overpriced, then vol went up even more. So we saw vols go up from like 90 to 180 vol as Bitcoin plummeted. And then since then, it's behaved more like equities and stocks, where vols have dropped as it rises and rises as it drops. But we've actually, over the past 3 months, it's been very interesting indeed for me. Probably boring for everybody else, but I've seen whenever Bitcoin sells off, vols don't go up. It's like nobody believes it. People just assume it's going to go back up again. And when it goes up, nobody believes it either. So they just sell it, and it all mean reverts. So vols have just been kind of hovering around the sort of 50 range in the 1 month plus, and sort of just under 50 in the 1 week at the money vols.
Yeah, it's going to be interesting to see what happens. I just jumped over to a chart looking at Bitcoin on daily, and from a technical perspective, I mean, this, 30 to 32,000, that was the previous support that it bounced off, bounced off, bounced off, and now of course that's providing resistance. So I think that if for the Bitcoin hodlers out there, I think that's the area you're looking through. If it can punch through 32, if it can get through that, look out. I think you'll see 35, 36 pretty quick. I never like to make predictions because I'm not a predictive guy. I tend to just see what happens. But it's good to have some of these general levels in your head, especially if you want to start selling. If I'm going to sell some, a spread or something, 15 days out or 30 days out or whatever. It's good to know if you're approaching these levels, and because you probably get some resistance there, even if it busts through that. Usually it'll get hung up for a while and enough time to buy those options back.
So what's your take on if we drop down? Should you sell puts as well, or is that dangerous?
I feel it's dangerous, to be honest, to sell puts. Yeah, I'd be more inclined if this keeps rallying up. I'd probably just start to accumulate some long puts, super cheap, just to have them, and then maybe we could sell some puts against them then. But I wouldn't be selling naked puts or spreads unless we had some stupid dump. Bitcoin goes from wherever 29, 28 it is right now. It drops down to 25 quick. I would sell some short-term put spreads. Sure, no problem. Maybe some 30 deltas, something like that. But
yeah. I actually, for the record, I systematically buy puts. The reason is that my book, handling customer money, you don't want to give them a horrible surprise. So I spend about a third of my profits on buying puts.
And you're buying deep out of the money, Richard. What kind of delta are you typically looking at?
I've got puts that are anywhere from, at the moment, 30 to 10 delta. I tend to buy them systematically. I don't and let the market spread them out for me. But I do it not because I think they'll ever be in the money. I do it because if crypto does crash, within the 2 minutes that my auto hedge has got to chase it, it's going to do it on the downside.
Yeah,
and I never want to be looking at a $2,000 hole that I can't fill.
I mean it's
with customer money.
Yeah, no, it's insurance, and we've seen crypto make big enough moves. It's just a wise thing to do. And of course, for people out there who are occasionally buying, if things are plummeting down, hey, buy some cheap calls. Things are ripping up, buy some cheap puts. Don't have any expectations for them. But we can use those as a later date. We can sell calls or sell puts against them if it started going the other way, and it can sometimes pay for itself, even if the long option itself doesn't pay for itself. It's nice to have in your back pocket. And the other thing I'll just mention too is you want to spread those expiries out. So you've got some shorter dated, you've got a little bit of longer dated, a little bit of protection there because you're going to see the big vol difference across those that time frame.
Yeah, one of the things that we do is, I follow a very very strict systematic trading rule set when putting risk on. But what I do every week is comb through the book. I should probably do it more often, but I do it every week. I comb through and I have a look at where risk is accumulated. So both in terms of which expiries and also which strikes. And if I've got, what I like to see is like the same number of contracts on each strike on a given expiry. And the reason is that if one of them if it's short and gets in the money, I don't want to have to deal with more than just that one. I'd like to deal with that one. And I can roll that away, or I can do something about it, or buy it back, or whatever. And then I can worry about the next one, $1,000 up. Whereas if you've got like 10 bitcoins all on one strike, then if you're short and you have to re-hedge it, it's going to hurt. It's going to really hurt your P&L, and maybe even cause you problems on margin because you're doing it all at once. And if you're long that option and it's not quite getting in the money, it's just going to be burning theta, like a hole in your pocket, and you want that kind of spread out. Right? So, and then if I've got, then I might be all spread out on one expiry, but I've got nothing on the next expiry, and then a whole bunch on the one after that. Well, what I might do is just move some risk between those expiries and get them spread spread across the expiries as well. Because again, I'm happy to be dealing with a small problem on one expiry, but I don't want to deal with the entire book on one expiry, because again, it creates a massive P&L hole and it gives you a bad feeling. And if you're in a job answering to customers like me, then they start phoning up and complaining.
Yeah, you don't want to see those big drawdowns in any given period of time. You want to keep things fairly smooth if you can, for sure. Yeah. So hey, let's wrap this up soon. What are your thoughts going into next week? And again, we don't make predictions. I mean, I have no idea.
Yeah.
Sometimes I have thoughts. And sometimes I'll slightly position one way or the other. But
so my thoughts. I mean, I'm the world's worst predictor of spot. If ever I give you a prediction of spot, do the fucking opposite, and you'll make money for sure, right? So, because I can read people, but I can't read markets, which is odd, right, for someone who does it professionally. But that's not what I trade. I trade mispricings, and so last week we saw in the news a bunch of people on the sort of crypto options platform saying, look, vols are really low. You really should be buying vol. And traditionally, that's kind of correct. Vols are low for what they are, for what we're used to in crypto. They're in the sort of bottom 15th percentile of historical values. But there's a couple of things here. The guys telling you to buy vol are probably market makers, and so they are probably long vol themselves, want to get rid of it, and because everyone's been selling it, and also vol is one of those things that can, like any market, it can stay depressed for longer than the markets that it seems sane, right? And so vols might stay low for another day, or they might stay low for another 2 months or more. And I would hate to make the call too early to go and start buying vol. And so what I think I'll do is carry on selling it, net selling it. But what I do is I do a tiny trade every day. Because if I do sell vol, then at least I'm dollar cost averaging into it. If it starts to rise, and the next day I'm selling it at a slightly higher vol, and the next day at a slightly higher vol, and so I net sell into rising vol. And that tends to smooth out the PV, the P&L. Because the big danger is if your book is net short vol and vols double, then all of your positions go to 100% loss overnight. And so you kind of want a degree of smoothness there. You want, if that happens to you, you want a lot of your positions to be aged and therefore getting close to expiry. Because if vol doubles in 1 week, then your $100 option becomes a $200 option, and it's not a massive problem. But if vols double in 3 months, your $2,000 option becomes a $4,000 option, and then that's a massive P&L hole that you've just suffered. So you don't want too many 3 months to be short, too many 3 month strangles. You want it to be staggered down through the expiries. And so I find that selling a little bit every day or buying a little bit every day helps me dollar cost average into that vol, and it eases the pain when it comes, because I know it's going to come. I know one day I'm going to have to report to my clients that we've seen a 4% drawdown from the high watermark because of vol spikes, but I'm totally okay with that, because I know that then any vol I sell after that's going to be at a higher price, and vice versa for what we buy. Right now I'm buying vol super cheap, so all that protection I'm buying on my book, when we do get a big scare and the market dumps by, I don't know, $4,000 and vols double, well, all that protection doubles in price, and I'm reporting a massive P&L hit, P&L profit that day. And I can cash in. I'll then be able to cash in some of those puts and record it as permanent P&L.
So long story short, you're going to keep selling vol next week.
I'm going to keep doing what I do. I do a mixed strategy. I buy and sell vol at different strikes, different expiries. I keep it mixed, but net I'm short vol at the moment.
Yeah, it's funny because I'm kind of joking asking you for prediction, because both of us are like, I don't know, but I will admit this, Richard. Sometimes you'll come on to our Telegram channel where people can ask this question, we post our trades, and you'll sometimes say, you know what, hey, I think the market might go down. I want to sell some calls here. So the
Yeah,
minute you do that, I'm inclined to take the opposite position
you
because
should.
it usually goes the other way.
You absolutely should do the opposite, because the market lies in wait for me, and whenever I say
Yeah,
anything, it tries to conspire to make me look a fool.
yeah,
I'm the Jim Cramer of crypto markets.
yeah. But fortunately, like you said, you've got the systematic programmatic way, and you smooth out the curves, and you make money doing that, and it works very well for
Yeah,
you.
yeah,
Whereas I'm a little bit more opportunistic. I'm
yeah,
more trader. I'm waiting for something stupid to happen, and then I'm jumping in. Or if nothing's happened for a long time, then I'm thinking, okay, I'm looking for the breakout.
yeah,
So
yeah,
sort of do
yeah.
two.
Well, I mean,
Yeah.
when I used to trade more on my own account than sort of corporate, then I I was a natural vol seller. I still am a natural vol seller. It's my own account. But I will wait these days until I see something that's worth selling.
Yeah.
I'll give you an example. On the day of the interest rate decision, 6 hours before, 1 week and less, vols jumped from 45% to 80%, and that was a clear, easy money making opportunity. Selling 80 vol in a market that's dead calm, no brainer. Sell it, right? And I know it's close to the money, and market could rally and all that, but if you're vigilant and you're happy to sit there and hedge and diligently hedge, that's just money on the table. And if you were really, really, careful about it, you could like sell the one day vol and buy the 2 day vol and just sit and let the arbitrage play out, because you're selling 80, buying 50. That's easy money.
Yeah, and for people that don't hedge automatically, that's where we can look at calendar spread,
Yeah,
or just a straight vertical spread. Put some protection on. Okay, you might lose a bit on it, but the probability
yeah,
is upside with this 45 to 80 example. I mean, you got to take advantage of that. It's
yeah. I mean, look, if, in any other market, if you saw like a 30-20 vol spread, you would jump on it. But looking at a 40-80, I mean, go for it, right?
yeah, yeah. One thing I will mention before we wrap it up here at vol. I mean, we've seen vol, in Bitcoin and Ethereum really come down this year. It's just it was so high for so long and so much uncertainty. A new market, a new asset. We've just seen it kind of calm down. We've seen long periods of calm, where it's like done practically nothing for 6 weeks or something. Or
You mean vol? You mean vols or price?
Well, the price made these sometimes big moves and held, but vol is just kind of creeping down. And when we see, vol,
Yeah.
people are saying, well, maybe buy vol now. I'm not so sure. I wouldn't be surprised, because if it actually dropped even a little bit more, I wouldn't be surprised. I'm not saying it will, but I wouldn't be surprised.
There's a couple of sort of pieces of wisdom in the markets about vol, and it's the same as prices, really, which is that dropping vol will tend to continue to drop, and rising vol will tend to continue to rise, until it doesn't, obviously. But and the longer a thing's been happening, the longer it's going to continue. That's kind of a Nassim Taleb thing, because people get used to it, and they actually get complacent. And let's face it, 50 vol isn't really low. I mean, if you saw 50 vol in the equities markets, you'd sell the arse off it, right?
Yeah, I mean, crypto exposure. We're used to 100 vol.
50 vol is like gold during a gold crisis, or oil during an oil crisis. And I think we kind of got a bit shell shocked and spooked by the markets of the past couple of years. We saw this massive, egregious moves up and horrifying moves down, causing vols to go everywhere. And people, it's not like that. It's not as if people were pricing vol off the realized vol anymore. They were just pricing from fear. They were like, I've just got to get puts at any cost. What do I have to pay? And to use the 200 vol, and done.
Yeah. Woo. Yeah, it's quite a run. And I've when was the last time a new asset came and started trading? I mean, You know, you got the early 70s, the CBOE starts up. I mean, you know, options trade before that. There's no formalized, you know, mechanism. You know, sure.
Particularly an asset which has united the pink-haired weirdos with the politicians in their utter hatred for it, right? Because you've got an asset which burns energy to exist. So you know everyone hates that, even I do. And at the same time, you've got an asset which is completely out of control by any central banks or money cartels in the city of London or in New York, which of course means the governments hate it too. But the people love it. People, a certain subset of people love it just because it isn't what the rest of money is. So yeah, there's massive sort of tensions pulling it in all directions as people are terrified of being out of it, terrified of being in it. You know, it's great. You know,
and that's why people need to trade options, because they're not. You don't have to invest in the physical asset itself. You could bet on its price movements without.
Sorry, I'm going over the time, but just on the subject of 200 vol, when the markets were dropping, was it last year or year before? I did buy 200 vol puts, and I did still make money on them.
Incredible. Is this a story you'll tell your grandkids? You're like, one time I bought 200 vol. Really, Grandpa? Yeah,
back to bed, Grandpa.
yeah. All right. Hey, let's wrap it up. Let's do this again next week and chat. I'm sure it'll be an interesting week. We've got lots going on, so let's talk that.
All right. Cheers.
Okay, bye.